Thank you for standing by and welcome to the Z Energy Retail Fuel Market Study Draft Report. All participants are in a listen-only mode. There will be a presentation followed by a question and answer session. If you wish to ask a question, you will need to press the star key followed by the number 1 on your telephone keypad. A recording of this conference call will be made available on the Z Energy Investor website. I would now like to hand the conference over to Mr. Mike Bennett, CEO. Please go ahead.
Hi everybody, it's Mike here and I'm joined by Matt Hardwick, our Head of Investor Relations. Thanks for joining us on the call today. The format we thought we'd follow, I'd probably speak for about 10 minutes just outlining a number of key points that may be in addition to what you've read or heard as a result of the Commission's draft report that was published this morning. Then we go to Q&A to give everybody the opportunity to ask any questions that they have of us that we could answer. And as the operator said, we'll be recording the call to make this available on our website to any other investor who was not able to join us at this particular time. There were 3 things I wanted to make in my opening comments by way of points. One is just reinforce what were the draft findings from the report, give you a little bit of our first thoughts as we've reflected on the report itself. Now, as you can imagine, there's literally hundreds of pages there, but we've got some advice from various people that we rely upon to help us with this sort of stuff. Then I thought I'd just outline what we see as the next steps, and then we'll go to Q&A. The Commission themselves have been really helpful in providing a one-pager of what they called their draft findings. So it was shown as an infographic on the various attachments that you could have downloaded from their website this morning. And they make 5 market observations that I thought I would speak to. They say that Z's petrol and diesel prices, the industry's petrol and diesel prices are among the highest in the OECD. We'd like to actually better understand that fact set because we have been working with MB in the past, because we had some concerns about the way in which that data was both being collated on a global basis and then being used for comparative purposes in New Zealand. So, for example, it only focuses on premium fuels and they differ wildly, as you would expect, across the market, as opposed to using the more common low-octane grade as the best determinant of actually how competitive fuel prices are. So we're not surprised that we're up in the upper end of the OECD table, but we have a concern about the accuracy of that data. They make the comment that many New Zealand fuel companies are profitable. We don't disagree with that at all. They make the commentary that retail fuel prices differ across regions. Again, we don't have a different view to that at all. They note that it is an indication of varying levels of competition, and we would agree with that. Our perspective on that would be something like perhaps the Auckland market you would expect to be more competitive because it's a much more concentrated market. It represents 35% of national demand, and that looks quite different to a market like, say, Christchurch in the broader Canterbury region, which is only about 12% of the market. We also are very keen to work with the Commerce Commission to make sure they have the most recent data around this sort of stuff, because even since our last results announcement, the amount of discounting that's taking place, so that what we would refer to previously as main port pricing, it's into the 90s now by way of exception. I think last time we spoke to you it was in the high 70s. So things have and continue to evolve across the regions of New Zealand. They make the comment that discounting is a poor substitute for price competition, and we would agree with that. Our perspective would also be that loyalty programs or rewards or fuel discounts, whatever label you like to put on it, is that they are highly valued by a proportion of the market, a large proportion of the market and a growing proportion of the market. They also observe that premium petrol margins have grown quicker over the period that they've looked at than the lower octane 91. We would agree with that. That's also not different to what you would see even a market as competitive as Australia, where I think it's fairly commonly held that the way in which premium fuels are marketed and the demand for that product and the customers seeking that product have been willing over time to pay a higher price or a greater spread to the lower octane fuel than they were perhaps 10 or 20 years ago. So in general, we agree with their market observations, though we obviously have some particular perspectives on that we'd like to share with them. They talk about the core problem being at the wholesale level, and in some respects this is not a surprise to us. We've spoken quite openly with you as our investors and made other forms of public commentary around the way in which the borrow and loan coal, the terminal infrastructure actually works across New Zealand, and that's our language for the wholesale markets. Their perspective is that there are only really three major wholesalers in New Zealand. Clearly, Gull is a form of a fourth wholesaler, although they are clearly limited to their infrastructure at Mount Maunganui. And so in their draft report, they make a number of comments around things that could open up or further improve competition at the wholesale level, because in their view, that has quite a significant impact on what ultimately shows up by way of retail price competition. They've suggested a number of things that they believe could boost competition. I thought I would just give you some commentary on that. One of those, or the two main ones, the first one is that they think that there should be greater contractual freedom for our resellers, or what people we would call distributors, to be able to switch between suppliers. We have a point of view on that, obviously, and that's not a surprise to us, given this was a topic of conversation leading up to the draft report. And they've also made a comment that there should be, or there could be, wider participation in the joint infrastructure as a way of further improving competition at the wholesale level. We think this is something of a tricky area, given that companies have made investments over many years to determine a position that they have, and to simply open that up to everybody without having the right economics around that opening up would be not just a concern for our industry, but I think other sectors in New Zealand would find that a very interesting proposition to go forward with. They also make commentary about some other things that they think would help competition as well, and these are certainly things that we have no concerns about. One is that the refinery allocation process should be reviewed, because in their view, a 3-year rolling average of market share is not the most current way or the most reflective way to have allocation determined by the refinery. I think some senses here they may have misunderstood, or we haven't communicated clearly enough that the refinery is not a significant competitive advantage in terms of pricing. So if you have more or less access at any point in time, that doesn't confer upon you significant advantage. They suggest that the way in which the industry works could be amended such that there's less information sharing, because they believe that the sharing of that information allows us to have better views on one another's performance, which clearly it does when we understand what people's market shares are and then act accordingly. They think that premium prices should be put onto the price board to allow for transparency and greater customer choice, and we would certainly have no concerns about that. And they said that there should be an agreement for which data on an ongoing basis is captured, such that there is ease for future analysis to be done should that be required. So those last 4 points that I talked about are not on the infographic, but I thought they were worthwhile mentioning because they are 4 of the 6 suggestions being made, or what we might even classify as remedies being suggested by the Commerce Commission, that we would have absolutely no problem with, and indeed they're entirely consistent with some of the arguments that we have made both publicly and privately. When we reflect upon this with our advisors, and we have legal advisors, we have people who help us out on the economics of it all, and we have people who are very, very familiar with how the Commerce Commission works and their way of thinking and doing analysis. The first conclusion is there's nothing unexpected in this report. I wouldn't want anyone to hear that as being we have no concerns or we just think it's all fine. Just want to let you know or reinforce that there's nothing in here that was new to us or unexpected based on our own view as informed by our advisors. We've been directed to pay most attention to the executive summary, because that's the area that most likely reflects the views of the commissioners, whereas the hundreds of other pages that support that is more likely to be the analysis and the perspectives of the staff and the work that they have done. It's quite important to note that a lot of the commentary being made or the suggestions to increase competition are things that are structural rather than any comment on actual behaviour. We think that's quite an important point in 2 respects. One, there is no implication there at all that any one of us individually or collectively have been behaving badly from a competition perspective, and it also makes it much clearer by way of a way forward in terms of being able to offer up remedies. Structural remedies are always highly regarded by regulators, as opposed to behavioural undertakings are way less reliable simply because they require ongoing monitoring, whereas if you made a structural change, it is done forever and a day. Probably the most interesting piece that I think we will dive into significantly is just their whole perspective on returns, their analysis of profitability. their determination of what they would consider to be a reasonable range for the weighted average cost of capital. We think that's going to be subject to a reasonable amount of inquiry and challenge. For example, I've never heard of Tobin Q as a form of analysis before. Not surprising, I'm not an expert in econometrics, but there are some limitations of that particular type of analysis. And we are very surprised at their conclusions on the return on average capital employed that Z achieves. Now, we provided them with a heck of a lot of data, and we were very pleased to be able to do that, but at no point in time in the process were we given the opportunity to review any of their work papers to determine that they had correctly interpreted or assigned in various ways the data that was given. So I can very easily put my hand on my heart and say we have never, ever, ever returned on capital in the region that they're indicating, which is, I think, low 20s on one of the graphs. At best, we've been in the low teens over the last period of time that we've been a public company. In terms of our next steps, we now need to sort of digest and determine what's our response to this. And that really is because the draft report is available for us to make submissions on. Those submissions are due on the 13th of September, and there's a heck of a lot in there, so we have to be very mindful that we want to concentrate on the things that matter most rather than be potentially distracted by other things that are perhaps important to clarify at one level but not really material to the outcome that we're looking for here. Those submissions are due on the 13th of September, as I said, and then on the 24th to 27th of September there is a consultation conference that they will hold based on those submissions. All of those submissions will be publicly available, albeit suitably redacted where required. 3 days of that consultation process yet to be structured in a way that we can share with you. What I can simply say is part of that will be open to a sort of a public hearing type format, and some of it will be private. That's entirely consistent with even how the recent RAP inquiry went as well. There are sometimes things that need to be discussed behind closed doors for reasons of confidentiality, and there are other times where it's really good to have a broader set of stakeholders in the room observing. On the 11th of October, or whatever comes out of that consultation process, by the 11th of October we will have been required to put in any post-conference comments that we want to make. I'm not sure what comes out of the conference such that we could comment on, so at this stage it would simply be us commenting on what we observed in the conference by the 11th of October. And then at that point in time they will then take all of that and everything they've learned on the way through to finalise their report, and they've confirmed that is still targeted for the 5th of December. So with that said, I'll pause, and I'm very happy to take questions, so we'll go back to the operator to moderate that for us.
Thank you. If you wish to ask a question, please press *1 on your telephone and wait for your name to be announced. If you wish to cancel your request, please press *2. If you're on a speakerphone, please pick up the handset to ask your question. Your first question comes from Grant Swanepoel with Craigs Investment Partners. Please go ahead.
Hi, Mike and Matt. What fun. A couple of questions. What is your premium? What do you reckon the market's premium share of the market is? So premium petrol as a percentage of total petrol sales?
It's about 25% of the total petrol market.
Okay, so that's quite meaningful. You said you've done your own work on OEC metrics for low octane. Where do we fit on your table on that front? Top quartile, mid-range?
Grant, I can't recall what our conclusion... Actually, no, we haven't done all the work on low octane simply because there's something like 30 or 40 countries in the data set. What we have observed is that the price competitiveness of low octane is a much better measure of how competitive fuel prices are rather than premium, because as you can imagine, there's a whole lot less price sensitivity around a premium fuel full stop. And the sheer difference in quality is significant the more premium, well, I was about to say the more premiumized a fuel becomes, but the more premium a fuel is, the more price diversity that you actually get. What we uncovered when we did dive into why was the graph that MB produced showing such a wide variance and why were we such an outlier, that's where we noted that this is not an apples with apples comparison in terms of product grade, and also the way in which the data is being gathered, frankly. It is not being gathered as all fuel prices being paid by all consumers for a particular grade in a particular country. So some samples are larger than others, so it can have some skews in it. That
So
said,
your view is we should stack up better?
We should stack up better, and that said, we would expect fuel prices in New Zealand to be at the higher end of the OECD because we're a long, skinny country. We have greater costs to operate. We have a far lower scale than other countries, and we are significantly away from big liquid supply points. So I think even a market like Korea, which I think is one of the top 3 countries in terms of the fuel pricing according to that graph. I mean, they've got a massive refinery complex, and they export significantly to Asia and the west coast of the US, yet their fuel prices are one of the highest in the OECD.
Okay, and then thanks, Mike. And then on the return on capital employed Shetty charts, or actually more on the Q ratios, in your book values, they're using storage terminals at 172 million. How does that stack up against the replacement costs they're using for Gull at 80 to 120 million? I thought you guys had 10 terminals.
We have, yes, we have access to 10 terminals. Some of those are joint ventures shared with others in the industry, but another way of saying that is we have more than twice the amount of steel on the ground that Gull does. So it seems odd that our book value or the replacement value of our terminal assets is only twice the size of Gull. So again, it's another example, I think, of perhaps some data we need to better understand how they formed their conclusion.
Okay, then my final question. Does this lead to a terminal gate pricing regime maybe which potentially should play into your hands?
Yes, we've often spoken about our frustration about the way in which these industry arrangements work and how they have relatively disadvantaged Z against the other major players. It has certainly made it more difficult for us to compete to supply wholesale fuels to the plethora of independent players out there. So that's entirely consistent with what the Commerce Commission has said.
But other than terminal, sorry.
So what we've always said that we've been mindful about what we do with those industry arrangements, and terminal gate pricing was one of those, and we understand our investor frustration around us not moving quicker on that. In some respects, our delays have been vindicated by this report that says this is an issue for the Commerce Commission, and we may be better off working it through them as a remedy to what they've identified, and that may be able to enable quicker, fulsome progress to be made than going individually and bilaterally negotiating something.
But other than terminal gate pricing, how can the government, who will now have to make decisions on how to implement changes, how else do they give access to the backbone that the big 3 control?
Well, I'd be speculating here because I haven't seen what they're suggesting beyond the headline of opening up the infrastructure. As I mentioned, that comes with difficulties in terms of what that means for other industries in terms of legacy positions that get opened up to new entrants. But equally, there are some physical limitations. So, for example, if you said for Z's terminal in Lyttelton, we have to open it up for anybody to drop their own fuel into, well, Z can barely get its own fuel into the empty tanks that are there using our best freight economics. If we were then to be subject to somebody else coming along and being able to use our infrastructure to drop their product in, that starts to make for a very messy supply chain. So I'm not saying that this is a stupid idea. I just think we have to be really mindful in how we work with the Commerce Commission and potentially government post their final report about how we create the right amount of competition within the wholesale markets to give them the confidence that they're looking for and not inadvertently raise the costs of doing business for all participants that ultimately shows up in consumer prices.
Thanks, Mike.
Your next question comes from Jeremy Kinsaid with UBS. Please go ahead.
Hi, guys. First one for me, just around the refinery. I suppose coming away from your Investor Day, where I suppose you've always said to the market you are always assessing the sort of need to hold that asset and how it fits into your business. I suppose following these outcomes, will this drastically change your view on that asset?
No, it doesn't drastically change our view in the near term or in the medium term to that extent. Yeah, we've always recognised the refinery has a role to play. It is somewhat strategic for us to be a holder of it. I'd be very interested to see what the refinery have to say by way of submission to what's been said here, because what role do they have or not have in the competitiveness of the wholesale markets? So even something as simple as let's change the refinery allocation. I don't know how that would help or hinder their own operational activities. So for now, nothing changes. Again, I'd reinforce that we expected this sort of outcome because it's been a bit of a burr under our seat for a while anyway, so it doesn't change our view today on our perspective on the refinery investment.
Okay, sure. And then just another one, I suppose it's kind of a hard one to answer, but I suppose looking at the market 5 years from now, these proposals are obviously intended to reduce the price at the pump for the end consumer. But on the other hand, as you say, it might make it easier for you to lift prices within the wholesale market. So naturally, the moving part there will be in the retail space. I suppose, how are you thinking about the market looking like in sort of 3 years' time if these proposals go ahead and you are able to increase wholesale prices?
Yeah, so I'd slightly change the language. I wouldn't say we'd be looking to increase wholesale prices because that's the sort of language that, frankly inflames a variety of stakeholders. What I would say is we would seek to get a reasonable return on our infrastructure assets, which happens to be demonstrated through the wholesale price. So they do go together. And we do believe that we're advantaged with our infrastructure assets and that one of our major competitors has significantly benefited from that. They benefit by not having to build the infrastructure themselves, by accessing our stock as and when needed, or indeed being able to bring big ships to New Zealand and put their big ship inventory into our tanks, and therefore their freight economics are much more flattered than if they were having to just simply put that product into their own tanks. So the issue here for us, that's always been part of our strategy, and we've been very clear on that, is to make sure that the scale we have in our infrastructure, our supply assets, is reasonably rewarded for the risks and the investment that we've made. Now, we think on a relative basis, if this was to change, and indeed it looks like it potentially will, that would advantage Z relative to the two other majors. What that means in terms of competition at the retail level will yet to be determined. But we've always been very clear that our infrastructure assets are returning below WACC, and at one level that's not acceptable.
Okay, that's all from me. Thank you.
Once again, if you wish to ask a question, please press star 1 on your telephone and wait for your name to be announced. Your next question comes from Robert Stevens, who is a private investor. Please go ahead.
Good afternoon. I noticed that your share price is down 22 cents today. I don't know if that's got anything to do with the draft report. Your comments there?
I would guess that it probably has. I mean, markets respond to news, and this is, one could argue, is the only news that came out today. We haven't said anything about our profit performance or anything about our strategy. So I would say it's highly likely that the share price has been affected by the news that came out this morning. What we do know is that the amount of volume being traded is not particularly large. It's a little bit up on what it would normally be for the day, but it's not outsized in any way. And it's quite a large number of trades. That indicates that it's more retail investors who are doing what they are doing versus perhaps institutions. And the advice that we've had from some market participants is that the morning session looked like some selling, and then the afternoon session looks more like buying and selling. So perhaps there was a response to bad news that's been demonstrated by what happened first thing this morning, say pre-lunchtime. And then in the last couple of hours, it's been more about perhaps a normal market day now that the market is digesting the news.
Okay. Now, you're also, I think, someone like Fisher Funds has dropped you from one of their main investments earlier this year. Does that leave any shaky feelings on your part?
Not necessarily. I think Z is as we are. We like to think that we're pretty transparent around our strategy. We keep the market up to date on performance. From time to time, some institutions will have more regard for Z or have greater confidence in Z's ability to deliver on its promises than others. I've been around in this job for all of the time as us being a public company, and I think we've moved in and out of the Fisher Funds portfolio during that period. The same way that they might have, say, taken us off their conviction list right now, there are others that have us on their conviction list or on their buy list. So I think that's pretty well how markets work. Everyone forms their view and then they act accordingly.
Okay. Now, if I was a tourist and came to this country and rented a car, I go around and I look at all the prices. In fact, the published prices, the big signs outside your stations, they're probably 10 to 15 cents above what the average New Zealander, if he's smart, pays. I give friends coming, I'll give them a batch of 3 cards that a company supply in order to get 11 cents off, and it gets charged to my account, and then they pay me before they leave. But the whole part about, say, AA, who's supposed to be an advocate of the motorist, they're the biggest offender, in my opinion, with their Smart Fuel card. Then you've got your one that you've just come out with now, or maybe you haven't just come out with, but you're advertising it more heavily, and you stack your fuel savings, and it's all nonsense. Let's get back to an open market where you don't need these stupid Green Shield stamps type of thing. They failed many years ago. Discounts. The cost of your advertising, and everybody's advertising, so you go in and you get discounts. It's madness. It's adding to the cost of the pump price.
And Robert, I think you raised some really good points there. Perhaps if you could give me a call, I'd be very happy to go into the detail of all of that with you and hear your thoughts. If you'd like to give me a call, say in an hour or so's time or at your convenience, I'd be very happy to go into the detail of all of that with you. I think there are potentially others who have more, perhaps I call it strategic questions, or questions that would help them decide whether, like Fisher Funds, they're in or out with us. So that's probably best to use our collective time for.
Thank you.
But thank you for coming in.
Thanks, Robert.
Your next question comes from Neville Lewis with Jarden. Please go ahead.
Good afternoon, team. So really my interest is focusing on 2 areas. One is the Commerce Commission's sort of executive summary pointing out a desire to give greater contractual freedom to resellers. And I'm wondering, does this sort of kick into overdrive some of the dynamics we've already seen over the last 3 or 4 years with the resellers, and your thoughts, initial thoughts at least, about that aspect if it is implemented? And just in terms of the infrastructure sharing, specifically the borrow and loan system, and talking about getting third parties involved in that, is that even achievable? And just what your thoughts are on that aspect, or whether terminal gate pricing really is the only workable solution rather than borrow and loan involvement. Thanks.
Yes, I'll take those in reverse order if I could, Neville. I think you've quite rightly pointed out the significant complexity of the borrow and loan system. It's hard enough with 3 participants, let alone having it with more. So I would be of the same view as yourself, that sort of some form of terminal gate pricing with the right amount of tension around wholesale prices is a far better outcome for all concerned. Because this isn't just about competition at one level. If you complicate the borrow and loan system, you then run the risk of running out of fuel. It's as simple as that, given New Zealand's a long, skinny country far away from liquid markets. In terms of resellers, I think I draw a bit of a distinction here. I think, and again, we've got to test this with the ComCom. I think when they use the term resellers, they are talking about what we would call distributors. So this doesn't call into question the wholesale contracts we have with our Caltex retailers, for example, or what other companies might have with their retailers. So it then ends up with, in Zed's case, sort of 3 or 4 participants that would fit into that description. I think it'd be most unusual, if not highly potentially outrageous, that those contracts were cancelled overnight and then the whole market got competitive around rebidding for those. These contracts range in tenure. In some cases, with Zed, they are with farmlands. Some aspects of the farmlands business may be on a very, very long-dated contract. There are other relationships we have that are on a shorter-dated contract. So I would expect the Commerce Commission to take 2 things into consideration. One is, what is the tenure of those contracts, and what, if anything, do they consider to be reasonable? So in some respects, grandfather existing contracts for a period of time. And then there'd also have to be, and we would be advocating or submitting on this basis, to be mindful about what does that mean. So Z just went and paid a heck of a lot of money, $800 million, for a company called Caltex New Zealand that had effectively a whole series of wholesale contracts and very little assets. And we valued the earnings stream on those contracts working through to expiry. So if there was to be a disruption to that, we would have something to say about that, and I think the Commerce Commission would need to be mindful of that. The third point I'd make is that at no point in the past have any of our distributors, as Z's distributors, made any complaints to us or to any other party about the unfairness of those contracts. In actual fact, we refer to these more as partnerships rather than a contract. So we do think that we would be able to work with our existing customers around this in a way that was productive for them and us, and potentially met whatever threshold the Commerce Commission require. What this does do, of course, it does open up Z to be able to better compete for the wholesale supply to many others. And we spoke about some of this at our Investor Day, and we gave you the landscape on what that looks like by way of the volume across those various channels. Given Z's strong commitment to investing in infrastructure and the amount of inventory that we carry, we think we would be a very attractive supplier for people who are currently supplied by another brand. So there may be some downside in all of that, but equally there may be some upside that opens up for us. But as I said, I think it's highly unlikely that these contracts would be terminated in the short term.
Great, thank you.
Your next question comes from Andrew Harvey-Green with Forsyth Barr. Please go ahead.
Oh, hi, Mike. I guess my question is just around, following on from your comments, and certainly heard you mention it before, that I guess you view the returns you get on the terminals infrastructure is below WACC at the moment, and I guess that kind of implies the retail side of things might be a wee bit more. But I guess the point I'm trying to get and be interested in your comment is that obviously the Commerce Commission seems to be focusing very much on trying to open up wholesale activity, which how that actually therefore achieves reducing returns in the retail space is I haven't quite worked out, to be honest. I'd just sort of be interested in your comment on that. And is the reason, I mean, if WACC returns are so low on the terminal front, is that the main reason why I guess you haven't been investing in storage over the last several years?
Yeah, so we haven't invested in storage because Z doesn't need more storage. Z is quite nicely sized, and as we mentioned at Investor Day, we have about a 45% market share, but about a 55% tankage share. So, from an industry perspective, we're overly contributing to others, and we're nicely sized if we were to be totally standalone. In terms of how making changes here can improve competition in the retail markets, I think the example that I would point to is one that the Commerce Commission used, which is around Gull, who have claimed on numerous occasions that they don't have access to terminals around the country, therefore they're not able to go out and compete, and therefore bring into the market the Gull effect, as it's described. Now, I have a slightly different view to Gull on that one, of course. We already have independent players in the South Island who are bringing significant price competition to those markets. For example, there are times in the last year where Invercargill has had the cheapest fuel in the country, and at one level that's nonsensical given the distance and the cost to get fuel to the bottom of the South Island. So I think what the Commerce Commission their analysis has led them to conclude that opening up those wholesale markets, so if you were, and I'll use the phrase terminal gate pricing, if there was competition at the terminal gate between three suppliers in any given location, if people had infrastructure there, that was one way to increase competition, and then other players would be able to, the retailers or the distributors or the resellers, as the ComCom refer to them as, they would then be able to take advantage of that wholesale price competition at the terminal gate and then reflect that in how they go to market for their own retail business. Z anticipated some of this. In actual fact, we made changes to the way in which we transfer price inside the company about 3 years ago, and we really made it very solid 2 years ago, so that Andy Baird, who runs our retail business, when he buys a litre of fuel off David, who runs supply, he is paying a competitive price that gives David the return on capital employed he needs for the supply infrastructure. So Andy's already got used to competing as if David was supplying everybody else in the marketplace. So we measure Andy's performance based on that transfer price. So there's no subsidisation that takes place. And that's why we're somewhat surprised, and we don't understand how the ComCom have got to these levels of return for the retail business that they've ascribed to us in their report. Does that answer it adequately, Andrew?
Yeah, no, that's good colour, thanks.
There are no further questions at this time. I'll now hand back to Mr. Bennett for closing remarks.
Great, thank you very much. So I appreciate everybody being on the call, and we've made comments here, and we've made ourselves available for any other follow-ups that anybody has as well. We think it's really important that we're as well informed as we can be. What I will mention is that something I shared in a note to the staff, the team this morning, where I said that nothing changes until it changes. And I'm not suggesting that nothing will change here. I just think it's really important that there's a number of months of work to be done as we go through to get to whatever we get to. And we'll make sure that we meet in fullness our obligations around continuous disclosure to make sure the market's really well informed on whatever we may be learning through the Commerce Commission process. And for things like public events, say the consultation conference, we would make sure we had an investor call after that to make sure we were available for any questions that you might have. And the submission that we make to the Commerce Commission will give consideration to whether or what timing we make that available to you as our investors. So if it's going to become public at some point in time, do we make it public by giving it to you the same day we give it to the Commerce Commission, or later on? We'll have to discuss that with the Commerce Commission. But we're very committed to making sure we are as transparent around this as we can possibly be. There's clearly some levels of uncertainty or questions that are yet to be answered, and we'll make sure that you're as well informed on that, noting that it is subject to a final report. That final report may not be the answer in itself, and that's where we've always spoken about the political risk that goes alongside all of this. The Commerce Commission may reach its own conclusions, it may make recommendations, it may even agree with us a series of remedies that shape those recommendations. That will still be subject to the politicians getting the report and accepting those recommendations or not. So we are equally attentive to making sure we engage with the political side of things to make sure that we are well informed about what's on their mind, and they are well informed about the way in which we're participating. So thank you very much, everybody, and we'll keep you posted. Thank you, operator.
Thanks, Ashley.